A burger doesn't usually signal a financial strategy, but sometimes it does. And sometimes, the smallest menu change reveals the biggest lesson about money. For nearly 70 years, the Whopper has been one of America's most recognizable fast food products. It was introduced in 1957 as a larger, more satisfying alternative to smaller hamburgers. At the time, it sold for just 37 cents. Adjust for inflation, that's about $4.36 today. Yet in many locations, it sells for much more than that now. That difference isn't just inflation, it's perception. Recently, Burger King announced it is elevating the Whopper. Not reinventing it. Not replacing it. Elevating it. That word choice matters. Elevation suggests improvement without disruption. It reassures customers while signaling change. According to company leadership, they're putting the burger in a tuxedo instead of a leisure suit. That metaphor isn't about taste. It's about positioning. The core sandwich remains largely the same. The flame-grilled beef patty hasn't changed. The lettuce, tomato, pickles, and onions are still there. What changed are the signals: a more premium bun, better tasting mayo, and a shift from paper wrapping to a custom box. At first glance, these feel cosmetic. But in consumer psychology, cosmetic details can drive financial outcomes. Presentation shapes perceived value. Studies consistently show that packaging alters how we evaluate taste and quality. When something looks premium, we assume it tastes better, even when the ingredients are nearly identical. 2. This is known as the expectation effect. Our brain often experiences what it anticipates. Higher expectations create higher perceived satisfaction. Now consider the box. A paper wrapper feels fast and inexpensive. A box feels structured, deliberate, and substantial. That difference changes the mental category of the product. It subtly moves the burger from cheap fast food toward premium fast food. And mental categories influence spending tolerance. In finance, this is called pricing power. Brands with stronger perceived value can raise prices with less resistance. Brands seen as cheap struggle to justify increases. Fast food operates on thin margins. Ingredient costs rise, labor costs rise, and rent increases. Without pricing power, profitability shrinks. So companies must protect perception. If customers feel quality stagnates while prices rise, they react negatively. But if quality appears to improve first, price increases feel justified. This is value anchoring in action. The upgrader presentation sets a new reference point. That new reference makes higher prices feel reasonable. Franchisees reportedly invest around $4,000 per year to implement these changes. Multiply that across thousands of locations, and the investment becomes significant. No company makes that move casually. This is a long-term brand strategy. Burger King is strengthening the mental positioning of its flagship product. The Whopper isn't just food, it's the identity of the brand. When your company calls itself the home of the Whopper, that sandwich becomes an asset. If that asset feels outdated, the entire brand feels outdated. And brand perception directly impacts revenue. Investors seem to understand this. Restaurant Brands International, the parent company trading under ticker symbol QSR, saw its stock rise following the announcement. Markets often reward strategies that protect pricing power. Because in business, durable brands matter more than temporary promotions. Discounts create short-term spikes. Perception upgrades create long-term resilience. Whopper itself was born from competitive observation. In 1957, founder James McLemore noticed a rival attracting customers with a larger burger. He saw demand and responded strategically. Today, the demand is different. Modern consumers expect consistency, presentation, and experience. The strategy evolves accordingly. Notice, what didn't change? The flame-grilled identity remains intact. The core flavor profile stays familiar. That balance is intentional. Radical reinvention creates risk. Subtle refinement protects loyalty while signaling progress. In behavioral economics, signals often matter more than substance. A softer bun alters texture perception. A boxed presentation alters weight perception. These sensory details reshape how the brain evaluates value. And value perception influences willingness to pay. We don't just pay for ingredients, we pay for how something makes us feel. We pay for how it fits into our identity. When you open a boxed burger, it feels different than unwrapping paper. It feels more intentional, more premium. That emotional shift supports financial outcomes. Better perception strengthens brand equity. Stronger brand equity supports revenue stability. The $4,000 annual franchise investment isn't really about mayo. It's about protecting long-term margins. It's about reinforcing a premium mental category. 2. The Whopper began as a 37-cent competitive move. Today, it's a strategic pillar inside a billion-dollar corporation. Its presentation now carries financial weight. The tuxedo metaphor captures this perfectly. The product remains familiar. The image becomes refined. Refinement supports pricing resilience. In an inflationary economy, that resilience matters more than ever. Because consumers don't evaluate price in isolation. They evaluate price relative to perceived quality. Change the perception, and you influence the evaluation. Influence the evaluation, and you influence the spending decision. That is the psychology of money at work. Companies don't just compete on product, they compete on perception. So the next time you pull into a drive-thru, look beyond the bun. Ask yourself, what actually changed? Did the ingredients change? Or did the signals change? Because in finance, perception is often the most valuable ingredient of all.